With you, if the banks start doing the Fed's job, which is what I guess some are hoping might happen, and maybe the Fed doesn't hike this month, you might start to say yay, but would that be the beginning of a bad news is bad news era where banks are battening down the hatches? Would that mean perhaps a greater chance of a hard landing?
In the fullness of time in that scenario, yes, but it doesn't have to be that way. What needs to happen right now is that central banks need to stop tightening, not pause to see what's going to happen, but stop. This is the end of the tightening cycle, and the next move would be an ease, is the right message, because monetary policy is restrictive as measured by an intense inverted yield curve, and an inverted yield curve and financial stability do not work together.
Just to dig into that a little bit more, Paul, before I get to the rest of the panel, though, I mean, we have the ECB policy decision expected tomorrow. I mean, do you think the ECB, in light of everything we've seen play out with Credit Suisse, is actually going to stop, or are they going to keep hiking?
I think they should stop tomorrow. I will not pound the table. They will, because that's not my specialty of expertise. But I think the Fed will stop, period. End of sentence.
Okay. Tony,
Morgan, I just want to mention quickly, Adobe's report is out. We are going through it. The stock is moving higher at the moment after hours.
Okay. A little bright spot there in the after-hours trade after what's been a largely down day for the broader markets. Tony, you've been pretty cautious on the equity markets for a while. Want to get your thoughts on everything we're seeing play out, whether these are one-offs when we talk about Silicon Valley Bank or even the other two regional banks that have failed in the past week here, or Credit Suisse, and I guess just how real the risk here is of contagion, or what that contagion could actually mean in terms of recession, when arguably we've seen the market today trading like we're going into a recession.
Well, Morgan, thank you for having me. So this whole thing, the banking system's in pretty good shape. I mean, there's one-offs, and I think that the story out of Silicon Valley Bank has more to do with the excesses over the last 15 years that have been built up in the private market and the venture market, rather than credit as a whole. But when you add all this up, we've been in the recession camp for quite a while because we follow the money. Like, I like to put aside some of the great academic stuff we do and some of the formulas and quant programs we make. Where are you going to get the money? The banks aren't lending it because the yield curves are inverted. This situation is going to make it so they're going to even tighten their lending standards further. Money supply has been negative for the first time post-World War II on a year-over-year basis. And the leading economic indicators are at a level that have always suggested a recession. So I think we keep asking the wrong question when we talk about, is the banking system safe? I think it is. The question is, when you're already at full employment and there's been a severe restriction already in money that's probably going to get worse, you still need money to grow and to invest. And the only good news that I can find in this, Morgan, and I think it is the good news, this doesn't happen at the beginning of stuff. This happens when you're already well into the whole event. By event, I'm meaning, the anticipation of a negative economic backdrop.